Welcome everyone to our Friday afternoon live chat. Interesting people in interesting times with interesting stories. And we have a very interesting and different one today than some of the ones we've been doing in past weeks. And before we get into that, we do want to do a special tribute for Memorial Day weekend. And this tribute is to our armed services, many of our clients around the world in the armed services and retired, as well as those who have defended our freedom or laid their life down for our freedom. And also the many healthcare workers and frontline first responders working in the current battle for coronavirus. We're going to do a moment of silence. And thank you for the many kind comments from last Friday's chat, where we had a special ability to benefit the nurses on the front lines of pandemics around the country. We've gotten some very special notes and emails from our clients, many of whom are retired nurses or current nurses, but also people just supportive of those individuals. So thank you very much. Today we have Casey Frazier. Casey is the Chief Investment Officer for Versus Funds. And as many of you know, we have a great partnership with the Versus Group. We're invested in a number of things in the real estate, infrastructure, agriculture, timber area with them. And so Casey is going to take us on a walk through coronavirus land and post C-19 with all of that. So welcome, Casey.
Thank you very much, Dennis. Appreciate it. And thank you for the opportunity to spend some time with you and your clients today. As Dennis mentioned, my name is Casey Frazier. I'm Chief Investment Officer and one of the co-founders of Versus Capital. Bill, if you want to flip to the first slide here, we'll jump in. Versus Capital is a boutique asset manager based in Denver, Colorado that really specializes in one thing, and that's investing in private and public real assets. Real assets are tangible assets that have intrinsic value, and we focus all of our time and effort in trying to figure out the most optimal way to get our clients access to these type of investments. As Dennis mentioned, that includes real estate, infrastructure, farmland, and timberland. Our clients are focused exclusively on fiduciaries, so those who are focused on providing their clients the best investment options, regardless of what that means to them and personally. And so we've decided as a business to limit the exposure and to limit the investments that we provide only to firms like Stearns. And so that's really critical in our opinion. We've selected our partners. We select only the best partners. That means that you cannot go out as an individual investor and buy the Versus Capital funds that we're going to talk about a little bit today in any way other than through a firm like Stearns. And we really value those relationships. We think that it is the correct way to invest and the right people to invest with.
Yeah, and Casey, I know today you're not really going to get into any of the investment area or returns or whatever, but I will mention that many of our clients are happy that you are down way less than the REIT index is down 20-25% year to date, and you guys are down 4 or 5%. So at least well done in the pandemic.
Well, thank you. Hopefully we can unpack a little bit of why that's been the case on this call, and we appreciate you as a partner, and we're glad that we delivered as we had hoped.
Okay, very good.
When we think about real assets, we like these asset classes because of the things that you just brought up. They've traditionally provided attractive risk-adjusted returns, with a good portion of that return coming in the form of a durable income stream while providing low correlation. And that means when the market is doing one thing, and really we only care, and you and your clients only care about when the market's going down, these asset classes typically hold up very well. And so that is a benefit to portfolios. It's the way that Stearns conducts their portfolios, by providing asset classes that provide diversification, and real assets really fit the bill in that way. As I mentioned, our focus is in real estate, infrastructure, farmland, timberland, and that's really what we're trying to deliver, and we will deliver that in a vehicle. Go ahead and go to the next slide, Bill. That provides a way for our clients to get that exposure in a more easy to use process. Historically, these asset classes have only been available to large institutional investors who could deal with investing in private funds, and there were a lot of challenges within those structures. They could be from very difficult reporting. We highlight here that the tax reporting for our funds is simplified. We don't have K1s, we have 1099s. It could be difficult in implementing. You could only buy into those funds during certain time periods. That's not the case given the interval fund structure that we use. An interval fund is a continuously offered closed-end fund that allows us to provide access to private investments within a wrapper or within an investment vehicle that is more easily implemented. We have two funds that we offer today. One is real estate focused, the other one is real asset focused. And we try to bring our clients' exposure to a really diversified portfolio within these, giving exposure to both private investing, so private equity and private debt, as well as public equity and public debt. And so this is the goal of our investments, is to provide this exposure on a broad basis to our end clients, which are firms like Stearns.
So Casey, I know you're going to get into this in a little bit, but I think there's some perceptions among some of our clients that maybe more of the threats are in the real estate fund and maybe more of the opportunities are in the real assets fund, but I'm not sure that's completely correct, right? So anyway,
yeah, that's right. You're trying to steal my thunder, Dennis. I will dive into that, and I'll talk about threats and opportunities in both funds. Largely, the reason that your clients are focused on that is that a lot of the press has been really focused on the impacts of COVID-19 to real estate. While we've seen some discussions around farmland and timberland and some potential impacts there, it just hasn't been as mainstream. But we'll talk about the impacts to each sector, some of the opportunities, some of the challenges, and we'll try to kind of unpack that a little bit in the next few slides.
Okay, great.
We'll quickly go through some definitions for each of the subsectors so that we're all on the same page, and we'll start with real estate. We really focus on one special segment in the real estate market, which is defined as core real estate. Core real estate, by its definition, is high quality assets. That means newer, well-built, well-occupied assets in these four major property types, which are office, multifamily, retail, and industrial. In major metropolitan markets, so markets that have high barriers to entry, high demand for the use of those assets with large populations and growing populations is a focus. And one really distinct characteristic is that we buy these assets, or this part of the market is very low leverage. So typically, real estate investors use as much leverage as they can because those cash flows are very durable and contractual. And so to get higher returns, they use more of the bank's money than their own money. We kind of turn that upside down and put it on its head and say, hey, we want stability in our portfolios. So one of the best ways to do that is just to lower that leverage and have more control of those assets over time. One key characteristic of core real estate and all of the segments that we focus on is a big portion of their return comes in the form of income that we receive from contractual leases of the users of these assets. Next slide, Bill. For infrastructure, that gets bantied about, the name gets bantied about, but we want to kind of dive into the way we think about it. We really divide infrastructure into 4 different areas. Transportation-related infrastructure, which are toll roads, airports, seaports, and railways. Utilities, that could be electricity or gas distribution or transmission, could be water distribution, wastewater collection. The communication sector, which is kind of a newer section within the infrastructure market, or the digital infrastructure, which obviously with COVID-19, and we'll talk a little bit more about this to Dennis's point, there are going to be some significant opportunities in digital infrastructure coming out of this. And then renewables, and that can be wind, solar, geothermal, hydroelectric. This is becoming a larger focus for our managers, just as the demand for renewables is increasing throughout the world, and we expect that to continue.
Yeah, and I'm sure you're going to cover, Casey, but a couple of the questions from the audience are around airports. Doesn't seem like they would do as well in this environment. And then actually quite a few comments about if you can lean in and talk a little more about that renewable power piece on the far right of that slide.
Yeah, we'll dive into the airports in a couple of slides here, but I will take the renewables. Historically, renewables haven't been the most, we'll call them most opportunity-rich environment, because they were largely driven by tax credit investing. And anytime you put tax credits into an investment structure, you start to decouple the economics of the endeavor from reality, is the way we kind of think about it. And so that's, as technology has improved, as the demand from the states and individuals has started to project the demand for renewables going up significantly, the economics now have then moved into a place where they make sense without the tax credits. And so we think there are going to be significant opportunities over the next 5 and 10 years in the renewable sector. We bring all of our underlying managers in at the beginning of every year, and every single one of our infrastructure managers, when they highlight their target acquisition opportunity areas for 2021, renewable power and the communication sectors were at the top of both of those lists.
So Casey, we have another question of, in these 4 areas, how do you make a decision to weight one of them larger than another one? If you think digital communications is going to explode, how do you lean between one versus the other?
Yeah, I guess the good news for your clients who are on this is that I'm not the person who's making that overarching decision whether I lean into renewable power versus communications. Versus Capital has gone out and hired what we think are the best managers in the world in each of these segments, and they build out diversified portfolios. So Dennis and I were talking about chess pieces earlier and how you move them and where they go, and that's what our managers are doing. They have teams of economists. They own assets within each of these sectors all throughout the world, and so they are going with a top-down macro view saying, hey, these are the areas we want to focus in. And then they have the bottom-up individual asset by asset level underwriting capability that I certainly don't have. So I have decided to partner with the best managers, and then they decide those chess pieces. Hey, today's a good time to sell utilities and buy renewables. And it's not only just at that top-down level, it's, hey, we want to sell the utility in Pittsburgh, and we want to buy this solar asset in Nevada, and that's the puzzle pieces. And then we get to oversee that, and they get to report back to us, and then we report back to Stearns how our managers are doing with those changes within those portfolios.
Okay, great.
On the next slide, we have our farmland. I'll go quickly here because everyone is pretty familiar with farmland. I will highlight that we invest in both row crops, the things that you traditionally think of as farm corn, soybean, cotton, wheat, as well as permanent crops. Really anything that grows on a vine or a tree, you can't change that out. They have different return characteristics and return drivers. We like them because that means that they provide diversification benefits. But overall, we love the farmland space. It has large secular tailwinds with population growth in the world, as well as declining arable land. And so we think that that provides a nice tailwind for the asset class. The way we invest in farmland is we buy the land and lease it to farmers who are experts and high quality farmers at that. And so we can take some of that risk of operating that farm and put that back to the person who's better at taking that risk. And so we lease this farmland, and then we get the opportunity to hopefully really receive the appreciation of that land value over time while collecting rent and income along the way.
Casey, we've got a couple of questions. I'm not sure the first one's actually a serious one of how much alfalfa demand is there during the pandemic? That seems fairly narrow. But the other one was around concerns about the supply chain for food. And, you know, we've heard some of the stories about the very difficult things that are going on in the meat packing industry and chicken packing industry. So does any of that affect these areas?
Yeah, great question. I think that's part of the reason I wanted to delineate between direct operating and leasing. And I'll get into this later as we go through each section. And I have 2 slides where I'll go through each section and talk about COVID impacts to them. But the good news for us is, one, we don't do anything in the ranching space, which would be the most impacted by the challenge in the supply chain there. And so far in our segment of our portfolio, all of our tenants have been paying the rent. That supply chain hiccups, as we think about how you get food, which used to go to a restaurant through Cisco, and now it needs to go to the grocery store, you know that there's some challenges in that. And that's why really you want to be very well diversified. The biggest challenges today in farmland, outside of dairy and ranching, which have the biggest challenges, are in the specialty crops, some of those vegetables that will die if they don't get to their endpoint, and rerouting them through the system can be a challenge. The good news is we're very well diversified there. Our tenants are very strong tenants, and we expect that to be a shorter term hiccup for those operators. And as with a lot of other things in the economy today, there is significant capital being set aside through fiscal stimulus, through the CARES Act and other farm aid bills, which will help those farmers who need it the most.
Okay, maybe you can follow up with intelligence data on alfalfa.
Well, alfalfa is interesting. We do have an alfalfa farm here in my home state of Colorado, and it's actually in the process of being converted to organic alfalfa, which I really, I'm sorry, I didn't know that was a thing 5 years ago. But as you think about the demand for more organic products, organic beef and other things, if you can feed organically organic alfalfa and grass-fed beef, you get some premiums there. And so I'll tell you what I know from this point is our rent checks have all been in for the year. They're representing that demand for their alfalfa, and those contracts are all going through just fine. So it's I guess it's anecdotal because it's only one farm, and I could do some more research and talk to our managers and get back to you on it. But from that one farm, all is well on the alfalfa front.
Okay, very good. Thank you.
Our last segment is the Timberland sector. Timberland investments are really segmented into a couple areas: softwoods and hardwoods. They have different uses of those materials. If you think softwoods are really in construction, building materials, and some packing materials, hardwoods are really some building materials and furniture. And so we want to be diversified along both those. What we like about the timber space is that that as trees grow larger, they become more valuable. You can do more things with them. Small trees, you might be able to make an Amazon box. As you get a large tree, you might be able to make 2x4s and an Amazon box. And so they grow over time. And so even in difficult environments like COVID-19, the value of those trees don't really know that things are going poorly in the economy and that people are losing their jobs. They just keep growing. And so that value continues to accrue. Now, it might not be the right time to harvest because pricing may go down in a difficult environment, but that optionality and being able to harvest when you want to makes this asset class very unique. It's different than row crop farming, for example, but it also, that optionality, there's some significant value there.
Okay, interesting.
All right, Bill, I'm going to dive into the portfolio a little bit and try to make sure I hit Dennis's questions about each segment and what's happening from kind of the impacts of the pandemic in this slide. So this slide will take me a little bit longer and we'll get through it, but please put in your questions. From a high level, the portfolio that we've put together for our clients like Stearns provides exposure to a number of underlying private funds managed by what we think are the best managers in the world, who collectively own a significant portfolio. It's over $135 billion worth of real estate in over 1,500 investments across the globe. With all of those investments in all of these different sectors and areas of the world, we started and came into this challenging environment with an occupancy of 94%, which is really important because a lot of the value derived from these assets are those contractual cash flows coming from those leases. And we're going to talk about how each of these different sectors are holding up, and how we expect them to hold up. And a lot of that is going to be based on those lease structures. Another key characteristic, given our focus, we focus on those four major property types, as you can see here: office, multifamily, retail, and industrial. That's kind of our core focus. Because we use that core investing philosophy, our portfolio has very limited leverage. Another key in a time like this, you don't want to have a lot of leverage and have to be refinancing a large portion of your portfolio in a crazy environment like the last couple of weeks that we've all been experiencing. This gives you flexibility and control of your portfolio and the ability, even when challenging times happen and cash flows may dip a little here or there, you have plenty of capital to pay those, to pay your mortgage. If you over lever the asset class, it could be a very challenging way to own. So again, we've really built this portfolio to be very conservative because our clients want us to be conservative, and has really been built for this type of environment.
Yeah, and I know you're going to be getting to it in a little bit, but it seems like more of the client questions are around the office and retail piece and how that's being affected. Perfect.
Let's jump right in. Office, the office sector has actually held up very well. Our managers are reporting, and we're very much in contact with them on a weekly, bi-weekly basis and getting updates on their rental collections so far. So April rents and May rents have both come in better than expected. Office rents have been some of the strongest in all of these sectors. And that's largely driven by a couple of things. One, our average office lease has over 5 years of maturity left to it. So you have a lot of contractual obligations with long maturity. So what that means is we don't have a lot of our tenants who are now looking to renew their office lease today. It's a small portion. And if you had a large portion, that could be a challenging negotiation, because if we renewed your lease on January 1st, the landlord had a lot of power. If you're trying to renew all of your leases on May 15th, the tenant has more power. And so that's really intentional. So office collections have been over 90% in our portfolio in April and May, and that's been really strong. That's because of those leases, and also because of the high quality nature of our portfolio. Our typical tenants are not startup companies or very small mom and pop operations. We own assets in major metro markets, and so our tenants are some of the largest tenants and corporations in the world, and these are obligations and operating obligations of those entities. And so what we found is that they've been paying their leases. This was very similar through the GFC. From a multifamily standpoint, I'll just go through these in order, and I'll hit retail in a second, Dennis. A multifamily standpoint, collections have been better as well, largely given people need a place to live, so they're very keen on keeping that roof over their heads. Also skewed a little bit for us because we focus on higher quality assets. So most of the job losses, unfortunately, have hit not our typical tenant in a lot of ways. Our typical tenant are higher wage earners and have not been affected to this point in the crisis. So that's been a very durable asset class for us today and has historically in challenging environments held up very well. Retail has been the biggest challenge. As many know, with stay-at-home orders and the forced closure of non-necessity-based retail, that has been an area where everyone has been focused. Our necessity-based retail has been doing very well. Obviously, we're all aware that our grocery store lines, the Home Depot lines, those are the CVS stores are doing as much volume, if not more, in most of our markets as they were doing pre-COVID. The other retail sector, the other retail assets, kind of more experiential-based retail, are struggling. We're starting to see some of that come back online in a number of states, but that's going to take some time, and we think that's where you're going to see the biggest challenges. Again, these are still contractual leases, so we are having some rent deferral discussions, but we know that a lot of these tenants have the ability to pay and will pay. They just wanted to defer that when they were closed and had the ability to do that. And so our managers are working with each of those tenants. And we've even seen a little bit of pickup in some of our retail payment, Dennis, which we think is interesting as a result of some of our tenants who are in like our grocery anchored shopping centers, some of that inline space that are more small businesses who were able to get some money from the PPP program and then pay their May rent. But overall, that's the most challenged environment. What's happening in retail isn't that it's drastically changed because of what happened with the pandemic. This secular change in retail was already happening, but it's going to certainly be accelerated by the pandemic. And there are going to be winners and losers from both retailers as well as retail centers. If you end up with the stronger retailers as a result of this, and you have the better retail centers, we think longer term it plays out fine, but there is going to be some challenges in the retail market.
So Casey, do you know offhand what percent of that retail are some of those grocery stores and Home Depots and CVS's versus the experiential?
Yeah, about a little over about half of our portfolio is grocery anchored, and then we have another 20% to 25%, which we would consider necessity, and then 25 to 30%, which is more of that experiential.
Okay, so it's a minority of the total.
Yes.
Yeah.
The secular shift down in retail is the opposite in industrial. Industrial has been the best performing asset class for a couple of years, and it will benefit significantly from this. We all know that the Amazon boxes are stocking up on our porches. You need a very significant logistical network to do what Amazon is doing and what they want to do, and that's going to have a significant impact. I know we're going to run short on time here. I want to make sure we get to the next slide and talk about what's happening in the real asset portfolio. So I'll cover the diversified property types fairly quickly. Medical office, obviously doing very well. Long-term leases to quality tenants, very good rental base. Self-storage has held up very well in this environment as well as historical down environments. It's a good diversifier within the non-core property types. Hotel is obviously the most challenging with daily leases and no travel. The good news, or I guess the good news for us is we have very little exposure there, and the exposure we do have is in our debt investing, so we have some protections there. Student housing has been better than we had predicted, but again, that's not a huge surprise given that we're at very good universities within our portfolio and the parents sign year leases. So even though they sent students home in the spring, those parents didn't want to ding their credit just to try to fight a battle there. So collections have been very strong there. We'll see what happens in the fall. As with our last conversation with our managers who focus on student housing, all of our universities are expected to open in the fall that we have exposure to. I know that there are some markets where that's not going to be the case, and we'll see how that all plays out. And then senior housing is going to face some challenges in the environment. A lot of that coming through higher operating expenses to those operators who now need to keep those environments very, very clean and have very strict regimens. That will ultimately get passed to the end tenants, but the operators are going to have to step up and cover those expenses in the interim. And so it will be interesting to watch how that plays out over the next couple of quarters.
So, Casey, I know we want to get on to the next slide, but just one question here. The exodus out of large urban areas, there's articles virtually every day about people want to get out of New York and New Jersey, for example, and move on your little map of the United States, move west. Yeah.
Tell them not to come to Denver.
Well, we actually, we talked to one a few days ago who probably is coming to Denver.
Oh, okay.
Yeah. So, but does that have any impact on you at all?
Yeah. So as we think about the demographic changes and movements of people, it will have impacts over time. And we've seen a big influx of kind of different age cohorts moving back into the cities over the last few years. And we're going to see if this was a lasting change, if people do say, hey, I don't, it's the health risk isn't worth it for me to be in a very cosmopolitan city with great museums and food and everything else in that market, then, and I want to go back to the suburbs, and you see that movement, it would have an impact on the demand for real estate. Our view and the house view of our managers are that this flight to the suburbs or to certain areas is very short-term in nature, and that as we come with a vaccine and or treatment, that this will be much like 9/11, Dennis, where people said, hey, no one is going to move back and put their employees in a large office building, and no one wants to be in these cities. Certainly there is some portion of the population that left, but we obviously saw that we have pretty short-term memories.
Okay, well, that seems to be the theme for the day. Since our morning chat, there was a lot of discussion about don't judge an event till time has aged it. So thank you.
I think that's a great way to think about it.
Yeah. All right.
All right, next slide, and I'll go quickly through this. I know we're running out of time, and I want to be sensitive as everyone has the Memorial Day weekend planned, and want to make sure we cover everything as much as we can, but be sensitive to that. As we think about our real estate fund, very similar for our real assets fund, diversification is really important to us, and getting broad exposure to these different areas and return drivers is what's important to us. So as we think about this portfolio, we have investments with our underlying managers that provide access to your clients and our clients over $65 or $68 billion worth of value across the globe in over 650 investments in 8 different unique sectors. And so that broad diversification is important. And we also have very low leverage as a focus here, only 11% at that underlying fund level in this portfolio. And so you can see the breakdown of each of these sectors. I'll go quickly through kind of impacts of COVID-19 and our expectations in each of these sectors. Let's think about it from an infrastructure standpoint. The majority of our infrastructure exposure are really tied to long-term contracts with high-quality off-takers of those things. Think, hey, Dennis, I'm sure you're even in this environment, you're going to pay your utility bills. And so for us to partner with these end users to build these high quality assets that are really necessity based, you typically have long-term contracts, which really limits the drawdowns and the cash flow impacts in these environments. So for the most part, infrastructure is kind of a defensive sector. There are certainly segments of it that are less defensive and are more tied to the business cycle and GDP. And as we talked about that earlier, airports being the most sensitive sector in all of this, we have less than 3% of our overall portfolio exposed to airports. It's obviously been a challenging environment for airports with no one flying. We still have some commercial traffic, and as we think about flying boxes and other things around, but certainly passenger volumes are down. We have those contracts where we have set contracts with those airlines and other things that help make it not so drastic of a change. But as you think about the volume of people, that really has an impact on those cash flows. We're starting to see that come back in our airports in Asia as they're moving a lot of those countries to open, but that's certainly been the most impacted sector within this portfolio has been the airports.
Yeah.
Roads have been impacted, but not nearly as much. Our rail and port, even less so than toll roads. And so that's our most sensitive kind of sector within infrastructure. Our other assets have held up very well, and that overall transportation sector is about 8% of our portfolio today. The other areas which have been doing really well, as you say, opportunity-wise, that communications and social infrastructure sector has been doing very well as more and more people are on Zoom calls and doing these things, consuming more and more data, and we expect that to continue. Our utilities have obviously held up very well, and then power generation renewables, again, have been doing very well for us with those longer term contracts that are within those portfolios. So we think about infrastructure, it's about balancing that GDP and kind of really inflation linked and business cycle linked to those more contractual cash flows on the other side. Our farmland and timberland portfolios have both held up very well. We've received our rents from all of our farmers within our farmland portfolio, and our timber contracts, while they're through this kind of cutting cycle, have held up. When you think about the demand on the timber side, while there'll certainly be an impact on new housing starts during this time period, some of that's been offset by demand for renovations, as well as that pulp and paper, as we're seeing more and more packaging demand through this time period. I kind of hit a lot there. I'm happy to take questions on any of those sections and go as deep as you want, Dennis.
No, actually, we don't have any other questions right now.
Great, we wore them out.
Apparently. So, good overview, Casey. And would you say that in terms of the post C-19 environment, I mean, you're talking to these managers on a regular basis. Is it the opportunities that they're more leaning into? Is it the mitigating the risk from the threats, or is it some combination of both?
Sure, it's definitely a combination of the two, right? I mean, when you think about all of these assets, and I really think about each of the underlying assets within our portfolio, kind of the 600 in our real assets portfolio or the 1,100 within our real estate portfolio. These are really businesses, and they run with a business plan and an operations plan. And so our managers are thinking about each of these assets in that way. These are distinct businesses and operating units. And so, first and foremost, you have to make sure you protect those assets. And then you say, okay, where are there going to be opportunities and when are there going to be opportunities? The first opportunities we're seeing today on the private side are really in the credit markets. As the credit markets in the public market dislocated, in late March and have stayed dislocated in a lot of infrastructure and or real estate sectors. That's created some early opportunities on the debt side. And so we're seeing some of our managers react there. The private market opportunities in real estate on the equity side and in infrastructure on the equity side will probably come later this year or early next year. And the farmland market, that market, hasn't really seen any much distress, and we wouldn't see opportunities there unless some distress picks up, and maybe that could be the result of some of the things you brought up, some supply chain issues that hurt some over-levered farmers, and so we'll certainly have our managers keeping an ear out for those opportunities. But I think the real opportunities today are on the debt side in infrastructure and real estate.
Okay, very good. Well, Casey, I know we have gone over a little bit and we're eating into your Memorial Day weekend, but we very much appreciate that far-ranging update on a variety of different real estate and real asset categories. Thank you very much.
Thank you. We really appreciate your time and appreciate you as a client. So happy to spend our afternoon together.
Okay, very good. And just a reminder to our audience that our live chats next week, we have several special edition live chats, and it's all things healthcare. So it's going to be healthcare related to C19, but it's also going to be all the things no one's talking about today, but maybe we should be, around other healthcare things that are moving off into the future. We have some really great CEOs of cutting edge healthcare companies that are going to join us for Tuesday afternoon and Friday afternoon, and then some special things Friday morning. So we look forward to seeing you then. And in the meantime, have a wonderful Memorial Day weekend.